So interest cover indicates the number of times profits exceed interest expense. This may indicate severe financial difficulties or that borrowings are too high for the company to support. The current year's profitability exceptional, so you have to look at all these things. Look at the elements that make up your profit before interest and tax. Look at the elements that make up interest payable and use your analysis using those elements. Dividend cover. Are you able, how many times? If you are looking at your profits for the year, how is it able to cover the dividends? Obviously, you have a dividend policy, you know how much you're supposed to be paying in dividends, but is your profit for the year able to cover these dividends? And how many times can it cover the dividends? From your share price, your market share price, how is it actually able to yield the dividends? And this is when I look at dividends over share price. Remember that there is a link between the share price, the cost of equity, the dividends. Depending on the dividend policy, if you're actually showing that your dividends shall be growing, on a yearly basis, you expect so many people to subscribe to those shares, and because of the demand being high, the share price will go up. So how is your share price able to yield the dividends? These are investors' ratios, price per share, market price per share, divided by your EPS. And the EPS is very important. It's the only ratio, so to say, that has its own accounting standard. I don't know why. So EPS can also be calculated, but that is dealt with obviously in the other chapter when you start getting into all those things. Here, if your price earnings ratio is going up, it shows the appetite, it shows the confidence that the investors have in your company, Yvonne, because then it means that your market price per share is higher than your earnings per share. Your earnings per share is the balance sheet income statement based data, which is historical. That is book value on earnings per share, but the price per share, those are the perceptions that the market has on your business. So a higher EPS, a higher price earnings ratio, it shows the confidence that the investors have and how they are subscribing to it. So thank you so much. We'll go into video 3 anytime soon. Thank you so much, and bye-bye.